It's begun. Massive layoffs rival the financial crisis. Watch what silver stackers are doing. Gold shoots up $200 and it is staying. It is staying. That's the most shocking part of the past 2 weeks. This is not just a quick spike. People are feeling uncertain, and that uncertainty is what leads to stacking silver and stacking gold. Let's start. The issue of AI is rearing its ugly head, and it will only continue to deepen the debt families are finding themselves in. I remember 2 weeks ago when gold jumped to this all-time high, and everyone was scratching their heads. They were looking at gold, and they were wondering what could possibly be the cause. Clearly, people are feeling uncertain with their employment, and many are drowning in debt. That's a recipe for people to move into stacking silver and stacking gold. Here's an article from I don't want to read the right thing. This is from CNBC, and it says layoffs rise to the highest for any February since 2009. The highest since any February from 2009. Layoff announcements, it says, in February hit their highest level for the month since the global financial crisis. The total of 84,000 planned cuts showed an increase of 3% from January and 9% from the same month a year ago, with technology and finance companies at the forefront. That's clearly AI. Now, from a historical perspective, this was the worst February since 2009, which saw 186,000 announcements as the worst of the financial crisis was seemingly coming to an end. Financial markets bottomed the following month, paving the way for the longest economic expansion on record, lasting until the COVID pandemic in March 2020. For the year, companies have listed 166,000 cuts, a decrease of 7.6% from a year ago. Challenger from this company that did this research, his name's Andrew Challenger, he says, as we navigate the start of 2024, we're witnessing a persistent wave of layoffs. He says businesses are aggressively slashing costs and embracing technological innovations, actions that are significantly reshaping staffing needs. I feel like we, as silver stackers and gold stackers, we saw this coming, and now it's clearly playing out. The article continues, with a series of high-profile layoff waves, tech leads the way this year in cuts with 28,000, though the number has fallen 55% from the same period a year ago. Layoff announcements at financial firms have risen 56% compared with the 2 months of 2023. So when I look at this, especially in those industries, the issue of AI is showing that this was going to happen, and part of this makes us feel that, as silver stackers and gold stackers, we have this sense that we want to hold things in our hands, and especially our wealth. And I think there's more that goes along with that. There's a sense that today's life, and especially with AI coming at us now, things are changing, and it's the complete opposite of what we embrace. Now, look at this further. Here's an article from entrepreneur.com, and this shows that it says in these cities, this is going to make your jaw hang open. It says in these U.S. cities, earning $150,000 salary is considered lower middle class, according to a new report. This is entrepreneur.com. 150,000 is lower middle class, right? It says rising costs associated with inflation, mortgage rates, insurance premiums, and other economic concerns have set new standards of success in the U.S., according to a new study by personal finance site Go Banking Rates. This says the report, which looked at the cost of living compared to salaries in different cities across the U.S., revealed that in certain U.S. cities, making $150,000 or less can be considered lower middle class. This is shocking. The city topping the list is Arlington, Virginia, where residents making between $91,000 and $152,000 are considered lower middle class due to the area's high cost of living, which is 41% higher than the U.S. average. We heard over the past decades that in order to have a comfortable middle class living, we needed a 2-income family, right? Husband and wife needed to start working. That started a few decades ago. And now to see that 150,000 isn't even comfortable living, that I feel like we are truly walking on thin ice within an economy like that. All this uncertainty, it's all uncertainty. All this uncertainty shows us that silver and gold, this is high end, by the way. I absolutely love this. Many people are not a fan of this Liberty, but I love it. But it shows us that those of us who go in on silver and go in on gold, that this is more than just a safe store of wealth. It gives us that certainty that is lacking, right? Just look at what's going on in the stock market. This is Yahoo, an article by Yahoo Finance, and it says default risks loom for nearly $2 trillion of junk-rated debt as U.S. companies are hit with higher interest rates. $2 trillion. These numbers are just astronomical. It says default and refinancing risks are climbing for U.S. companies over the next several years. This is according to Moody's. It says junk-rated firms have $1.87 trillion in debt maturing over the next 5 years. These are the riskiest investments. That's what junk-rated bonds are. It says strategists said speculative grade credit faces more pain and higher rates and tighter financial conditions. Non-investment grade U.S. companies face growing refinancing and default risks, with interest rates expected to stay high and financial conditions for borrowers tightening, according to Moody's. It goes on. It says the ratings agency says about $1.87 trillion of junk-rated bonds debt is maturing between 2024 and 2028. That's hitting now. That signifies a 27% jump from the $1.47 trillion recorded in last year's study. This is I don't need to tell you. You clicked on this video because clearly you're interested in stacking silver and you're interested in precious metals. I don't need to tell you the risks of the stock market, let alone the risks of junk bonds. Now, I'm not a financial advisor. I stack precious metals and I do diversify. I'm not just like, I invest in real estate. I do diversify. But when I look at reports like this, $2 trillion coming for junk bonds, it's just this all feeds the insecurity that we see with personal debt, family debt, unemployment with all these cuts, persistent inflation. That is exactly why we go in to stack silver. And I was thinking when I was starting this video that I should, instead of showing all of this high-end semi-numismatic silver and gold, I should show some generic rounds, but it's just not as pretty to look at. So that's why I chose to go with this high-end stuff. Well, here, this is pretty generic. This is just an American Gold Eagle. I'm not giving you much there. Now, the other part that is feeding this insecurity I wanted to get to is this constant flip-flopping over rate hikes, right? And this is from Barron's.com. It says, Fed is talking to banks with high levels of uninsured deposits. The Federal Reserve is keeping a much closer watch on the banking sector these days, particularly given concerns about commercial real estate. That is really where the pain is hitting with this new hybrid work from home, only going to work a few days a week. All of these, ever since the pandemic, all of these commercial real estate, these office buildings in large cities, San Francisco, Manhattan, they're really struggling. So this article says, while Chair Jerome Powell maintains that stress within the commercial real estate sector and the risk it poses for banks is a manageable situation at this point. That's a quote, manageable. He said, the Fed is proactively addressing it. We have identified the banks that have high commercial real estate concentrations, particularly office and retail and other ones that have been affected a lot. That's a quote. He said this in response from senators addressing him. He said, "We identify them and we are in dialogue with them." Powell added that the Fed has been talking to these regional and smaller banks for some time now, but that doesn't mean that having a game plan will forestall all of the issues. Powell says he said, I'm sure there will be bank failures. This is what he said. He said it bluntly. I'm sure there will be bank failures. And he emphasizes that it is smaller and medium-sized banks rather than big banks. Now, I use a local bank here in my hometown. There are larger banks. I could go with Chase. I could use Chase, but I choose to use a smaller regional bank, and I'm certain that it's going to be one of the banks that's failing within the next month or two. The staff is being cut constantly, and they're struggling. I get a sense when I go in there that it's like a mom and pop organization, and I never would have thought that way about banks. But I also remember when I was young, when I was a teenager and in my early 20s, there was a local bank in my town where I grew up, and same thing. I never thought of it as a mom and pop endeavor, these small banks, but that bank closed in my hometown. And in fact, if for those of you who collect banknotes, I'm just getting interested in banknotes. I found that there are some banknotes from that actual bank that I grew up in. Really cool. Very expensive because these are collector's items. So not for just straight bullion, silver and gold. That's high level collector's material.